All right, 1 week to go until my birthday and the election. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, Alphabet kicks off this week's big tech earnings. There's $20 trillion in market cap set to report in just 3 days.
And beyond big tech, we'll take a stock of a string of other corporate results from McDonald's sales miss to Pfizer's big beat.
Plus, finance heavyweights sound off on the global economy and the U.S. election. We're live at the Future Investment Initiative in Saudi Arabia. But first, let's take a look at where markets are trading right now. A down day. Of course, things could change mightily once we start to get those big tech results rolling in. But at least for right now, the S&P 500 off about 0.2% pre-market. Yesterday was gorgeous, actually. The NASDAQ 100 managed to close perfectly unchanged, true neutral. Looks like we're pretty close to that right now, maybe down a little bit on your big tech index. Then you take a look at the bond market. That sell-off reigniting, currently higher by about 4 basis points on the 10-year Treasury yield. Matt, we are above 430.
All right, and we get, of course, jolts a little bit later. Also, consumer confidence. One of the most fascinating reads on consumer confidence that I've seen, our chart producer Dan Curtis put this together in London. The yellow line is millennials and Gen Xers, so heads of households between the ages of 34 and 54. They're not confident. In fact, the gap to their confidence and the confidence of 55-year-old heads of households is the biggest on record. So what's driving that? We'll talk about it later on in the program.
Got to knock on their door. Give them something to see the glass half full, Matthew. You always do. Now, with some stocks to watch under the surface, a lot of glass half full. Trump Media and Technology now up another 22% pre-market. Second double-digit day, of course. We had a big rise yesterday. McDonald's getting some relief as well. Now, sales fell short of expectations due to weakness in international markets, but the CEO says the E. coli outbreak appears contained. You see McDonald's now up about 1.5% pre-market. Pfizer up also about 1.5% nearly. They raised their guidance for the year in the first earnings report since activist investor Starboard entered the chat. And D.R. Horton, we're taking an eye on that as well. It has been a tough morning. The shares had been plunging after reporting weak home orders and high interest rates. We are going to keep an eye on that. It looks to be up pre-market now, about 0.6%. But of course, Matt, something fascinating about D.R. Horton here is you've seen mortgage rates up for the last month. So home builder stocks are high in focus for that reason, especially.
Dang. Wasn't D.R. Horton down 10% a little bit earlier?
Yeah, I don't know about that, that board necessarily.
I see it down 14% right now.
I think that might have not been a pre-market board.
Yeah,
but
right. The feelings under the surface here felt like they were down, and agreed they were down at least 12%.
Yeah, we'll remedy that. But in any case, we are in the thick of earnings season. The point being, of course, you showed 4 big movers in the pre-market. And it's interesting. You take a look at earnings calls so far. This was a fascinating note from Bank of America.
The actual.
There we go. Bad vibes.
McDonald's down 1.6% too. That's another one that didn't.
Yeah,
hold.
DJT, of course, kind of true to form. It's up another. I know.
After 20% yesterday, it's up another 18% today.
And as we discussed, it's not necessarily the social media sites' fundamentals that's driving the stock. It's just an election proxy. 7 days to go.
All right, well, third quarter earnings season, as we've been talking about, really in high gear this week. Today, we're going to get the first of the Mag 7 big tech giants, Google parent Alphabet, set to report after the bell. Joining us now to talk about these big tech stocks is Stefan Slowinski, BNP Paribas, Exane Global Head of Software Research. He has an outperform rating on Alphabet with a $210 price target. And let's just go through all of them, Stefan. First off, good morning.
Good morning, Matt. Thanks for having me.
Thank you for joining us. Let's talk about the AI investment, because that's what it's all about. With all of these stocks, well, at least Google, Amazon, Meta, Microsoft, what do you expect in terms of Google after the bell today?
So first of all, for all of these stocks, you're absolutely right. You know, investors are trying to look at any traction with Gen AI, whether it be in terms of data around adoption or usage. We're starting to get a lot of products live and ramp. AI overviews. Yesterday, Google talked about rolling out to 100 different countries. Apple Intelligence is now live, and even Meta AI may be used by over 1 billion people. So first of all, we're going to look at those data points around usage. Obviously, investors also want to see what's going to happen on the CapEx side. How are we going to pay for that usage? So any signals into 2025 on spend. And then more specifically for Alphabet and to your question, I think it's an extremely important set of results. We have a new CFO, and we think that that's going to signal a change in communication practices from the company, which is super important because the company really needs to take control of its narrative.
It was bad and needs to be better, is what you're saying.
It's been challenging and it needs to be better, and we've seen this new sense of urgency from Google, we think, has been underappreciated. One, in terms of product development and getting product to market fast. Two, in terms of efficiency, they've driven margins higher. And now three, we think they need to improve on the communication front, and we think that's what the new CFO can do. So the surprise would be a Q4 guide, because currently they don't give guidance.
Yeah, okay, so definitely something to keep an eye on once we get those results. I'm looking at your notes. You talk about this Code Red initiative at Google following the launch of ChatGPT. You have to think that their core Google business has been challenged by these chatbots. And it's interesting, the information reported yesterday that Meta is actually developing its own AI search engine. It wants to lessen its reliance on Google. I mean, how hard is it for them to defend their search functions against chatbots?
Well, this is certainly where we're seeing that sense of urgency, right? Like I said, with AI overviews now being pushed into 100 different countries and multiple different languages. So they're really accelerating those go-to-market motions around Gen AI and trying to keep people using the platform and drive adoption. But we're also seeing Google push on diversification. Don't forget 30% of revenues already come from enterprise cloud computing, from consumer subscriptions. So they're really trying to diversify that business model. And they still have 15 different surfaces with over 500 million users each. So they're accelerating that deployment of Gen AI across all of those services to drive adoption of those Gen AI usages.
We also have to talk about just valuation here, because it looks like there's been a pretty significant overhang when it comes to Alphabet and the idea of any real antitrust concerns. Shares trading at 19 times earnings makes it the cheapest out of the Magnificent Seven. So even if they do come out with that guide...
That's worth repeating, I think. That's pretty crazy.
It's incredible.
19 times earnings is the cheapest of all Mag 7 stocks.
Right. So how much upside is there, even if they do give the guide that you're talking about?
Yeah, so 18, 19 times earnings next year, that's a fully loaded number with stock comp, and you're right, that's about a 30 to 45% discount to a lot of those peers. Now, obviously, the DOJ overhang is there, and so investors need to assign some sort of discount for that. But once we get beyond that, obviously, the core business continues to do well. Your question on search, the company should still be growing search and YouTube around 12%. And the rest of the business, we see Google Cloud beating expectations, growing above 30%. So when you look at even the free cash flow yield at around 4.5%, 5%, with the sector trading, below 4% free cash flow yield, you could see 20% upside here for Google, and yet still have a healthy discount to reflect that DOJ uncertainty.
By the way, does the DOJ, not to get too political here, does the DOJ still have teeth under Trump? If Trump wins, won't they be busy prosecuting the enemy within?
We'll see, but I think largely Google is not really viewed as a winner on election night either way, and so again, that's maybe a positive in the sense that that's already pricing in sort of any administration is not going to be favorable to Google. That's kind of the base case right now. So if that changes, then that could be upside.
All right, so a lot of focus on Alphabet, and deservedly so, of course, reporting after the bell. I do want to talk about Meta, because Meta has sort of been the shining star of the Magnificent Seven. You're neutral on Meta, I believe, and we had an interesting note from Peter Bukvar yesterday saying that the core business has been so solid that Meta has been able to weather this AI spend scrutiny. What do you make of Meta's core business at this juncture?
Yeah, so you're absolutely right. Meta's been a star. It's up 450% over the last 2 years off of those lows. We did actually initiate underperform in May. Part of the concern we have is it's still 99% advertising revenue. So whereas Microsoft, Amazon, Google, they've really diversified with enterprise revenue streams, consumer subscriptions. With Meta, it really all depends on them continuing to beat expectations in advertising. So they don't have the mechanisms just yet beyond advertising to monetize that Gen AI. The core business is doing well, but we're a little bit concerned about the Q4 guide, where you start to hit some headwinds in terms of Chinese e-commerce growth, in terms of the Reels year-over-year benefit, and also they may be taking away some investment in that core business to allocate to Gen AI, like the Llama model training or the Meta AI rollout, which won't generate revenues just yet. So that potentially could actually have a negative impact on the core business near term.
Now, how do you also think about Apple as well, just kind of in the news as well, this idea of Apple Intelligence and how long it will take to really feel the financial impact for that?
Yeah, I mean, I don't cover Apple personally, but clearly, like you said, they just launched that yesterday. And so we're starting to get these competing products in the market. What are consumers going to do? What are they going to use? Are they going to change their habits? Obviously, as we mentioned, Google's the one where there's the concern where people start to search elsewhere. But Google still has those advertising relationships, and they hope to still keep those monetizable searches, the valuable searches coming to the Google platform.
All right, that seems like a good place to leave it. Really appreciate the preview ahead of a big day, couple days of tech earnings. That, of course, is Stefan Slowinski of BNP Paribas Exane. Meanwhile, let's take a check on these markets right now. Not too much happening, you guys. You can see the S&P 500 down a little bit. Big tech really at a standstill on the NASDAQ 100, totally unchanged yesterday. And it was really interesting, of course, to hear Stefan bring up CapEx, because the CapEx spend and the forecasts, they matter for the names that are actually reporting, but they matter more for those hardware names that we're going to get. I'm talking about NVIDIA.
Did you see the chart I put in the chat just now? I mean, we talk about Facebook being the darling, and obviously Apple's done well, but if you look at a comp screen on the Bloomberg, over 5 years, NVIDIA just erases every other.
It's just not fair.
Yeah, no, it's up 2,683%.
It's like crypto levels.
By the way, we also have AMD aftermarket today, too.
Good
so
point.
It's a really good time to talk about those suppliers here.
Yeah, another chip maker coming out after the bell.
Yeah, of course, we're talking about hardware, we're talking about tech, but there's a lot moving underneath this market right now. Let's get a look at what's going on with Bloomberg's Jess Menton. Jess, take it away.
Well, looking at what some of the bigger movers are, I don't know how y'all feel about when it comes to sneakers and things like that, particularly maybe Matt. I know Matt likes the leather jackets, but looking at what's happening with the Vans owners, so VF Corp here, actually it was up almost 20% in pre-market trading, so it's actually rivaling some of its biggest move in years here. And so when it comes to, especially when it came to retailers, we talked so much about the margin picture, and that's where it saw a lot of improvement moving forward. So you're looking at that up almost 20% ahead of the opening bell here. Yeah. So you're helping see, potentially keeping an eye on what it could mean for other retailers as well, particularly maybe in the shoe space too, as far as what those could be moving this morning, guys.
When we're talking about Vans, do you know who Jeff Spicoli is? Does anybody here know?
No idea, Matt.
Jeff Spicoli?
I have no idea what you're talking about.
All right, let's move on.
Well, maybe later in the show. Anyways, another one I'm watching near to me in the financial space, SoFi. I think this is kind of interesting. Not moving all that much. Maybe that's a sign of stability here. It usually moves closer to 9%. Now it's down about 2%.
Right. So looking at that, just ahead of the opening bell, like you mentioned, Sonali. So when you're thinking about this, that stock's actually up about 12% year to date through yesterday's close. But also when it came to this, it raised its profit guidance for the third time this year. And of course, we know a lot of it's, when you think about the company and its dependence on the student loan kind of lending type services, it's been able to expand beyond that. So that's why you've seen that. But also, even when you think about outside of this particular company, obviously, I know, Sonali, you cover the banks very closely, and especially when you're thinking about investments and that kind of as far as what it means for that. But a lot of those big banks, obviously, a lot of that came in stronger than expected. But when you're looking at the lending side of things, obviously, it already had a little bit of a bigger move year to date here. So that's probably why you're seeing that stock not making a bigger move, especially ahead of the opening bell.
You know, we're going to get, I think, Royal Caribbean. We're going to get.
Yeah, so
we got this morning?
Right, so that actually, if you're looking at what's happening with them, and that's important too, because actually hotel and cruise liners, if you look in the S&P 500 year to date, that segment in the S&P 500 is up about 12%, but Royal Caribbean, even ahead of these results, its stock was almost up 60% year to date. So obviously we know how so many of them had so many issues, especially in the aftermath of what happened with the pandemic. But unfortunately, its outlooks fell short of those expectations.
Can you tie them together with JetBlue? Because it's really not the same business,
well,
right?
No, it's not.
I guess you could say they're both travel stocks.
But
they're
also,
both vacation stocks.
Right, but also JetBlue recently was trying to move away from the business type clientele. And so that's something that their shareholders were looking very closely. But when you're looking at that stock as well, that one's coming under pressure because they didn't deliver as much as investors had wanted them to with this latest results this morning.
It's fascinating. Took a look at Norwegian, actually also down today. In synchrony, people are worried about how much people are traveling right now. Thank you, Jess, so very much. That is Bloomberg's Jess Menton all over what's happening under the market for us. And coming up, big tech reporting after the bell. We have been talking about it. We've already had some heavy hitters this morning. We're going to take a look at Pfizer's earnings beat next, see what's happening as they fend off an activist. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Boeing is raising $21 billion in an expanded share sale. It's one of the largest sales ever by a public company. The beleaguered airplane maker is shoring up its balance sheet as it seeks to stave off a potential credit rating downgrade to junk. The stock has plunged 42% this year. And Ken Griffin, the billionaire founder of Citadel, expects the race to the White House to be close, but he says Donald Trump will ultimately win. He spoke at a panel at Saudi Arabia's Future Investment Initiative Summit. Griffin is spending tens of millions of dollars to back Republican primary candidates across the U.S., but records show he has so far resisted contributing to Trump directly. And Apple's iPhone exports from India jumping by a third in the 6 months through September. The data underscores Apple's push to expand manufacturing in India and reduce its dependence on China. The tech giant is taking advantage of local subsidies, a skilled workforce, and advances in the country's technology capabilities to make the shift. Sonali?
And we're going to stay on earnings here because Pfizer's stock up pre-market after reporting better than expected earnings before the bell. The pharma giant also boosting its full-year forecast. Here with more is Bloomberg Health reporter Robert Langworth. And it's really the first shot across the bow here from Pfizer as they look to fend off an activist investor in Starboard. But you still have really a significant plunge from that 2021 peak in Pfizer shares. How does this first forecast boost really start to help them, if at all, against this activist battle?
Well, this is certainly, some good news that they needed to buy them some time. The guidance raise and the earnings beat, a lot of that, and the revenue beat, a lot of that was driven by the COVID drug Paxlovid. Those sales went through the roof. They had $2.7 billion of Paxlovid sales this quarter. And last year at this time, there were 0 sales in the U.S. That went up. Most of those sales were U.S. sales of Paxlovid. So it's a lot of this revenue raise is due to the strong Paxlovid sales, and that's the prospects obviously for that is uncertain. The critique that the Starboard Value is given is related to what have you done since the pandemic, and all these deals that you've done, did you overpay and not get enough return for that? So this is going to play out over a while, and it's just not clear what's going to happen.
Well, to focus on the results a little bit more, as you point out, I mean, a lot of this came from Paxlovid and an uptick there. It's certainly a nice surprise, but judging by the stock reaction, reading through some of the sell-side notes, it doesn't seem like Wall Street and, of course, traders are convinced that that's sustainable.
Yeah, well, I think, Wall Street and analysts and investment community is looking for what can you do outside of the the COVID franchise? And the beat this quarter, appears to be primarily driven by just the kind of massive sales of Paxlovid, and also the COVID vaccine came in a little above expectations too. So they're still looking for all the deals that Pfizer has done. Which is the biggest one is Seagen, which is a cancer drug company they bought for $43 billion. Wall Street is still looking to what kind of returns are you going to get from that? And it's still early days for that. And that's where the debate with the activists is going to play out is what kind of returns are you going to get from these big deals you've done?
So they spent a ton of money. They have little to show for it. They don't have a viable GLP-1. Doesn't Starboard's approach make sense to you?
Well, I'm not an activist expert, so I can't, comment on
Well, let's put it this way, Bob. Let's put it this way, Bob. Could Borla or someone to replace him do a lot better?
Yeah, I mean, definitely, they need to show some returns. Wall Street wants some returns outside of COVID, some big blockbusters that aren't COVID. And the big thing before a couple of years ago was going to be obesity and obesity pills, and they made kind of big promises about that. And so far, those have not come to fruition. And they've had several setbacks on developing obesity pills. Now they're still working on that. That may still happen. But now the big focus is cancer, on this cancer deal. And so far, the biggest drugs in the cancer deal are still much smaller than, for example, the revenues they got from COVID this quarter. So. I'm not sure how much long term this is going to change things, but we'll wait and see what the market does when it opens.
Yeah, plenty to prove for Borla and for Pfizer. Shares currently higher by about 0.6% pre-market. Bob Langworth, really appreciate your time. Meanwhile, coming up, Starbucks employees are being told to get back to the grind in the office or else. Social climbers up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Boot Barn getting a licking after announcing its CEO will depart the company next month to become the CEO of Ross Stores. One TD Cowen analyst said that the departure was a major surprise. You can see that in shares pre-market down about 8%. Next up, we have Crocs tempering its full-year revenue guidance because of weakness in its Hey Dude brand. Hey Dude is the lightweight slip-on loafer brand that Crocs bought for $2.5 billion 2 years ago. Crocs sales growth in the third quarter, which includes the crucial back-to-school shopping period, remained flat. And finally, we have Starbucks telling its corporate employees that they could be fired if they don't come to work at the office 3 days a week. According to an internal memo, Starbucks will start to hold workers accountable if they don't abide to return to office policy. This comes less than 2 months since Brian Niccol took over as CEO, Matt. So get back to the office, but just 3 days a week.
Yeah, that doesn't seem too difficult. I've actually never worked a day from home. Have you ever worked from home?
No, not even during the pandemic, actually. But,
No?
you know, I do understand why this could be difficult for some people. It at least changes the base of talent that people are looking at. But, you know, when you work in the in-store chains, it's a lot more difficult.
Well, also when the CEO comes in and says, as long as you can do your job, I don't care where you are, then you make plans to do it from where you've been doing it. And then when they change the rules a couple months later.
When they change the CEO a couple months later.
Yeah. All right, coming up, less than 4 minutes to go until the opening bell. We'll discuss the market moves with Gabby Santos at JPMorgan. This is Bloomberg. We are moments away from the start of trading and 1 week away from the U.S. presidential election. This is Bloomberg Open Interest. I'm Matt Miller. You can see that we have a little bit of a mixed picture in terms of futures. We were up yesterday. We're really waiting for the big earnings to deliver after the bell. Google comes out as the first of the Mag 7 stocks to report. In fact, this week we have 42% of the entire S&P 500 market cap reporting. Here, the opening bell on the New York Stock Exchange. Paramount Group ringing the bell there. Down at the NASDAQ market site, we have Plug Power. A couple of companies that have been in the spotlight over the last few months, but we're really worried about the big ones, Katie. We're really looking forward to Google after the bell to, I guess, it's not going to drive today's market, but really the rest of the week.
It'll give us something to talk about tomorrow because at least for right now, not much to say. You can see the S&P 500 off by about 0.2%. We're really hanging out sort of unchanged on the NASDAQ 100, 0.1% higher if you're an optimist. Of course, all the fireworks coming after the bell, and then the days ahead, things are busy. You can see the small caps, though, a definite move there. The Russell 2000 currently lower to the tune of about 0.7%. Meanwhile, let's take a look under the hood. We do have some action, and that is in DJT. We are talking about Trump media and technology shares extending gains again. No real news here. This is just a proxy, of course, on Donald Trump's election odds. It's an unprofitable company, but this big boost that we've seen, finally the company is crossing the $9 billion mark. Shares soaring alongside those implied odds in the betting market. Sonali.
Watching some key earnings movers as well over here. I'm looking at PayPal. People souring on the financials today a little bit. PayPal's down after providing a Q4 revenue growth forecast. It disappointed, but posted third quarter profit that beat estimates. It's down about 6%. DR Horton, that's down almost 14% as the market opens, reporting weaker than expected home orders. High mortgage rates are straining buyers struggling with affordability. And we're watching the owner of Vans also climbing after results surprise on the upside. It is just surging, up almost 19%. Matt, isn't there someone you know associated with this that you think is part of this move?
Yeah, I was going to. I've been telling people today about Jeff Spicoli, and I can't believe that no one on this desk has ever heard of the man. Sean Penn played him in Fast Times at Ridgemont High. He really made Vans famous. here you see a bunch of stock moves. Do we not have a picture of Jeff Spicoli? I feel like
I don't think so. But, I mean, we do have that move. It was up 20% at one point, now up about 18%. That is the biggest one-day jump since 1987.
Incredible. So. That is some size and scope there.
The movie's from '82.
Wow.
You really should put it on your list.
I'm going to pass on that.
Okay. Let's check in finally on shares of another van maker, Ford. The car maker cautioned that full-year earnings will be at the low end of the forecast. We want to discuss this with Bloomberg's Keith Naughton, who almost certainly has seen fast times at Ridgemont High. I think really...
I definitely remember Jeff Spicoli, Matt.
Thank you very much. People of a certain age. Let's take a look at what's going on with Ford. It doesn't seem like they can catch a break. Now they're lowering their guidance for the full year. Is this the bottom? Can they turn it around from here, Keith?
They certainly hope so. You know, Farley is the CEO, Jim Farley, is very frustrated over these persistent, stubborn warranty costs that really are weighing on Ford's profits. You know, like General Motors and others, they benefit from this incredibly high pricing that's out there on cars right now, but it isn't, you know, giving them as much of a lift as their rivals because they have these high costs to repair their cars. They are the most recalled automaker.
Well, to that end also, how much downside really is there to Ford? Because, you know, we were just talking about this really just a day ago, I believe, Keith, and this issue has been pretty tough for them throughout the majority of this year. They've been pretty sideways since that plunge you saw in the middle of the year.
That's right. So, you know, they had the big surprise back in July when warranty costs were $800 million more than they expected. They said that they actually improved them a bit in the third quarter, but not enough. And so, you know, the last plunge in the stock in July was an 18% plunge. We're down about 6% now. It's not quite as bad as that route, but still pretty bad.
Still pretty bad. You add it all together, Ford shares now down over 11% year to date on a total return basis. And let's compare and contrast to what we learned from some of Ford's rivals in the past few weeks, because you think about Tesla, you think about GM really delivering in this environment where it seems like Ford can't.
Yeah, I mean, GM raised its earnings forecast for the third time this year last week. And then you saw Tesla. They delivered in their traditional car business. So we're not talking about robo-taxis or AI. They just sold more EVs than expected, and their stock soared. So along comes Ford, and it's a completely different story, and they're really being punished for that. They need to get their costs in line, and that's what's holding them back at the moment.
All right, Keith, great to speak with you. That is Keith Naughton in Detroit reporting on Ford and Jeff Spicoli, that's his name?
That's right. Thank you for remembering.
Apparently, according to the internet, he's a stoner surfer dude, so I'm going to file that one away. But let's broaden out the conversation now with JPMorgan U.S. Chief Market Strategist Gabriela Santos. It's great to see you in person again.
Good to see you. Thank you.
There are so many crosscurrents in this market, particularly at this exact moment, from the Fed, the election, earnings, the economic data. When you look out to the future, what is the true signal that you are following right now?
So I do think the skies are a bit cloudy right this second. We do have some distortions that are set to be impacting the data, at least for the next month. And here, especially the jobs market data coming out on Friday. We also have some policy uncertainty as the election is just a short week away. So I think the North Star for us really should be always, but especially right now, earnings. What's going on with two related themes within this earnings season? The first is a more structural theme that's happening irrespective of what the Fed is doing, what the election outcome is, which is all this AI CapEx cycle and this AI adoption. And then the other theme that's happening in earnings is really the cyclical storm is passing for a lot of sectors that are emerging from some of those pandemic distortions. And really this is a theme, of course, affecting the S&P 500 outside of the Mag 7, which is finally seeing margins stabilize and earnings grow again. So I do think we can tell a lot from the earnings season about these two structural and cyclical themes that are overall supportive.
But it sounds bullish. I mean, you sound bullish, right? The Fed is cutting rates. We're still looking at growth. The labor picture probably is good. And now we have AI spending and a structural push as well.
That's right. I think when we get GDP tomorrow, we do think it'll come in at 3.3%. And there are really two themes driving this. The first, of course, is the consumer on track to grow about real consumer spending 3.5%. That's above trend. So certainly consumers feel gloomy, but they're very much still spending at an aggregate level. That's still looking good, related to the job market, of course. The second big theme is this CapEx spend. You can really see it in the data when you look at industrial production, when you look at CapEx. It shouldn't be this strong when rates are this high, but it is because of all of the spending we're seeing communication equipment and semiconductors, in manufacturing more broadly.
What about fiscal? Isn't that a third rail? Because I was talking with Neil Grossman this morning. He's going to come on the program a little bit later from TKNG Capital. And I said, hey, Neil, we're growing at 3.5%. And he said, sure, we're spending, 10% of GDP in deficits. I mean, if we continue this deficit-fueled spending, the economy's going to be fine until it isn't.
So I think what's interesting about the deficit, it's at nearly 6.5% of GDP. It really shouldn't be this high on a non-recessionary economy. But if you think about whether it's stimulative or inflationary, actually not so much at this point, because a lot of it is being driven by interest payments. But I think the discussion is what happens at the end of next year around the expiring individual tax cuts and potentially additional tax cuts and additional spending. So yes, I think we've gone from an era where fiscal policy was very much focused on austerity and was a bit of a drag on growth, and so it was all about the Fed and lower rates, to now it being more of an era with elevated deficits and more fiscal activism. And that means the Fed can take a bit of a backseat, but it also means steeper curves, more anchored at a higher level long-term yields.
There's much more where that came from, but because we are in the thick of earnings season as well, you asked this question in your notes, this idea of when it comes to that CapEx spend that you're talking about, that expectations for AI revenue, how much of that is already baked into the pricing here? How much of that is really allowing for more upside at this juncture?
So, of course, really critical week for that structural theme of AI spend with 5 out of the 7 of the Mag 7. So I do think the first is just the AI CapEx spend itself, that every quarter, once these companies report, we keep revising it upwards. So exactly how much are estimates of 30% annualized growth for the next decade actually too low? Maybe it's even higher than that. How healthy is that CapEx spend? And right now, actually, the market's been okay with it because it's been stable as a percentage of free cash flow. And then lastly, who benefits? And I think the big theme of the last 2 quarters has been a broadening of the beneficiaries of that CapEx spend into utilities and industrials, which we should look at in terms of earnings reports. And then the last bit is actual revenue generation with AI. And that's where I think there has been a little bit more scrutiny around how much have we pulled forward in that expectation, how much is it nice to have versus truly moving the needle.
Yeah, and that definitely was the narrative of the last round of earnings. I want to dig into that point, though, that you made about the health of that spend, because I haven't heard that before. What is healthy, what is unhealthy, and how do you define that?
So I do think if we think back to 2022, when we had a correction, a pretty big correction within the tech sector, that was investors looking at the kind of CapEx spend that tech companies were doing and saying, look, this isn't likely to generate higher cash flows, revenues, earnings in the very near future. We're going to punish you for that kind of CapEx spend. And really a lot of late 2022-23 was reorienting towards more value-add kind of CapEx investment, which is now this whole AI and AI adoption theme. And when you do, you can measure it a few different ways. For example, CapEx spend as a percent of free cash flow. And it has been stable over the last 2 years, meaning companies are spending $200 billion on AI, but they're also generating $200 billion worth of more free cash flow. And so in that perspective, it is healthier amount of CapEx spending versus the metaverse and
So it's just the
other
return,
years.
Necessarily.
The kind of cash flow you're already generating for it versus the promise of it very late into the future if it happens.
I haven't heard the metaverse in a while.
No.
Well,
Remember that? Remember
you keep
that?
calling it Facebook still.
Facebook, yeah, well, I mean, it is Facebook, right?
It is Meta.
Yeah, but how much, what are they driving with their Meta business?
That's what
just
exactly.
losses, right?
Yeah.
I know. I just want to quickly talk. Gold has just hit another all-time high. I'm looking at Bitcoin right now trading at $71,500. Are we expecting an inflection in inflation? I mean, are these assets telling us, or at least warning us, of the potential of inflation to come back?
So it's been interesting to me that we've seen a rise in gold. Perhaps we could have Bitcoin, but long-term yields, the 10-year has risen the most in nearly a year and a half.
Right, and I think of Sonali's interview with Druckenmiller. I think of Paul Tudor Jones was on CNBC warning about this and saying that he's buying these assets.
I think in the moment, we continue expecting disinflation, and inflation expectations are still doing all right despite these moves. But what I think investors are aware of is that we may be in for a period of more inflation uncertainty, that 2022 was not a one-off. In the future, there can be another inflation shock. And we've been speaking to a lot of clients of preparing portfolios, not just for recession risks, where bonds do great, but also inflation shocks. And in that case, gold is something that stands out, as well as within alternatives, things like real assets. So I think that's not so much a short-term story about inflation and fiscal stimulus, but it's more of a question about
not
preparing
Bitcoin, though,
portfolios.
Right? How many decades is
really
Bitcoin going to have to run higher before plain vanilla, before regular strategists say, oh, I like it as an asset?
It's just that you can't quite understand its role in portfolio construction. Like, does it do well when inflation goes up or rates go up or recession, or it's just a bit more unpredictable in its role. Yeah. And so when it comes to actually sizing it or thinking about how it fits, it's a bit hard still.
It is the purest measure of risk appetite.
Yeah.
That's how I view it, at least.
Yeah.
Or DJT right now, which is halted again, it looks like, after surging another, well, that's a whole other story. Anyways, JPMorgan's Gabriela, Santos, we thank you so very much for your time. We're going to get back to earnings season next. Coming up, we're going to talk about McDonald's missing estimates in the third quarter, and it's because of sales outside the United States, but of course, containment on the E. coli outbreak. We're going to talk about the outlook next. This is Bloomberg. And over in earnings news, McDonald's reporting comparable sales that missed expectations amid weakness in international markets such as France, China, the UK, and the Middle East. But remember that it's also dealing with the deadly E. coli outbreak in the United States that it says is contained. We're going to break it down with Bloomberg Intelligence senior analyst Michael Halen, because you are seeing a little bit of a lift there in McDonald's stock, but it's really flat on the year because the issues that they've faced internationally have been plaguing it all year long. But when we think about the current set of problems that McDonald's is facing, what are they really saying about the outbreak and their ability to get beyond it?
Yeah, they think they've contained it from here on out, for sure. We think there's still a little bit of risk to the story. We don't think all of the cases have been reported yet. And so as those roll through, we think there's still some headline risk. We also, expect consumers to be skittish about, jumping right back into ordering quarter pounders with cheese at their local Big Macs, right? And so, we expect the fourth quarter sales to be impacted, and we expect, some of it to kind of spill over into the first quarter. It's the timing of it was kind of stinks for McDonald's. I mean, they had just kind of gotten their footing for the first time this year. They said same-store sales were up mid-single digits for the first 3 weeks of October, and I think that's why you're seeing the shares up very slightly today. Chicken Big Mac and the $5 value meal and some of those things had started to give them a little bit momentum. They said they've attracted some low-income consumers for the first time this year. But data from Bloomberg's second measure show that same-store sales were down about 9% last week. And so that's kind of wiped out any of the gains they've had for October. So, it's kind of a case of good news, bad news for McDonald's.
And you bring up the Chicken Big Mac. Looking through the transcript of the earnings call, that was the first question on the Chicken Big Mac. But give us a little bit of the flavor that you got from the call. Of course, that took place at 8:30 a.m. What was the tone? How many questions did they get about E. coli?
They got a couple. I mean, they're trying to stay on track, right? And attract consumers the way they've been trying to attract consumers, right? It's by improving the operations. It's through value. So it's going to be the meal deals are going to continue, and they're going to roll out the new U.S. value menu in the first quarter of next year. Operations, chicken, digital. They talked about some fourth quarter food innovation coming through. So, this is kind of the track that they've been on, and they're going to continue to try to execute on.
In terms of the other fast food chains, I know a lot of them have also been cutting onions. Does it make sense? Is it going to hurt their sales too?
No. Obviously McDonald's, there was a fatality. There's, dozens of people in the hospital. And so, I think McDonald's is the one that's going to, see some same-store sales impact. It probably helped their competitors actually last week. If somebody was driving by McDonald's and, second guessing their choice to go there, and then, maybe they stop down the street and hit up a Wendy's or a Burger King. So typically what we've seen historically is when McDonald's same-store sales slip, everyone else seems to benefit, right? Because they're just such a large presence with 14,000 stores here in the United States.
Michael, great to get your take. Hope we get you back on soon. Bloomberg Intelligence senior analyst Michael Halen there talking to us about Mickey D's. Coming up, some of the world's top economic minds converge in Saudi Arabia. We head to the Future Investment Initiative next in today's Wall Street Beat. This is Bloomberg.
There's no question the deal-making environment is improving. And when you look at what's going on with technology and the investment that's necessary, to power AI, I think that's a tailwind for deal-making over a period of time, too. Yeah. A lot of change, a lot of opportunity.
And that was Goldman Sachs CEO David Solomon speaking at the Future Investment Initiative Conference in Saudi Arabia. That conference is the focus of today's Wall Street Beat. We head now to Riyadh, where we are joined by Bloomberg's Jomana Berteschi. And we look at your interview, but you made this great point in the story you wrote as well about how Goldman has opened an office in the Saudi capital here, a new office. And then you also think about the fundraising landscape around the world, this idea that, yes, it's been hard to come by fresh capital, but the Middle East has actually been a prime source of financing this year. What are you hearing on the ground about the business opportunity?
Yeah, it's great to chat to you, Sonali, and I know that you know the story of Goldman better than anyone, but it was interesting to speak to David Solomon earlier today, and they have had a presence in the region, in the Middle East region, for a really long time. He was actually saying that this, I think, is the 6th or 7th FIA conference that he's attended. But the big news this morning is that they are one of the first Wall Street banks to announce that they're opening up a brand new office in this new Riyadh financial district. They were also the first Wall Street bank to apply for this regional HQ license that the Saudi government has been offering. So far, there has been good take-up, but Goldman definitely one of the first to get involved there. What they say is essentially they do see the region as a hotspot in terms of deal-making and activity, and that also ties into the broader conversation we were having. You played a little bit of sound there about how he sees the future of deal-making, and he says back on their earnings call, they mentioned that they had a decent M&A backlog that they look to work through. They're positive about the future of deal-making. That being said, their one concern is potential regulatory headwinds, and he also alluded to perhaps a change maybe in regulatory oversight once the elections are out of the way. But generally speaking, he was very positive, specifically also on the status of the U.S. economy.
All right, Jomana, great to get a take from you, even if it's short, and I hope we can have you back on this program as soon as possible. Bloomberg's Jomana Berteschi there at the IFF in Saudi Arabia. Coming up in the next hour, Citizens Financial CEO Bruce Van Saun joins us on the state of the banking industry and his post-election expectations for his company. And Neil Grossman, my old buddy Neil Grossman from TKNG Capital and the Norges Bank, is going to come on here and tell us his take on the Fed and inflation, as well as deficits. Definitely an interview you don't want to miss. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We are awaiting the JOLTS job openings data at the top of the hour. You take a check on where markets are trading ahead of that. Of course, a little bit lower on the S&P 500 as we await for those figures, getting them now a little bit lower than expected. Let's speak about it with Bloomberg's Mike McKee. Of course, he's our international economic and policy correspondent. Mike, what do we have?
We have 7,443,000, which is a big drop from 8,040,000 in the prior month. Now, these are September numbers. Of course, they're a month behind the overall jobs numbers. The separations numbers, which include the quits, layoffs, discharges, etc., total separations unchanged by down about 326,000, still 5.2 million. The quits rate is what I'm looking for here. The number of quits changing little, it says, but the quits rate unchanged at 1.9% doesn't tell a lot about what's going on. Interesting thing here, although some of my lines disappeared from this, but basically this is JOLTS and consumer confidence, which apparently hasn't come through yet. But the consumer confidence numbers, when they show up, which I've got now, consumer confidence tends to go up.
Crazy.
And consumer and JOLTS tends to go down during these political seasons. The consumer confidence index rises to 108.7, up from 99.2 in September. Present situation increases by 14 points to 138, and the expectations index is at 89.1, well above the Conference Board says the threshold of 80 that usually signals a recession ahead. So it looks at this point like Americans all of a sudden have gotten more confident about the economy. And my chart, which didn't show the presidential election years, was supposed to show how that affects the election.
Well, how does it affect?
Guys, it's the strongest monthly gain since March of 2021, according to Dana Peterson here. So
in terms of consumer confidence.
An incredible gain in consumer confidence there. But you see the market, you finally see it back rebounding a little bit, but you see the two data points kind of fighting each other, Mike. You had the drop in the S&P immediately after you saw the JOLTS, and then you have the consumer confidence, and this is all ahead of jobs on Friday. So how do you feed all of this into what we might see at the end of the week?
Well, it's hard to say exactly because we do have, and we were talking before we went on the air, Neil and I, about how do you measure what's happened with the hurricanes and things like that. That makes it a little bit more difficult. The biggest thing with consumer confidence is the number of the way people assess the labor market, and consumers apparently becoming more confident about the labor market. 17.8% expect more jobs to be available in 6 months, and the number of people who expect fewer jobs has fallen. Labor market in the current month is 35.1% say jobs plentiful, up from 31.3%. So people feeling better about the jobs report, and that has sometimes been an indicator of what we might see on Friday. The problem is we've got to work in the Boeing strike and the hurricanes and try to see how that offsets what we might get.
You were going to mention how the presidential, who's in office affects the job openings. What were you going to say?
Well, not job openings per se, but what the pattern had shown is that on times when job openings and confidence are a little lower, Democrats get elected. When job openings and confidence were higher, Republicans get elected. Now, that's going back to 2008. It's not a scientifically valid sample, but that's been what the recent pattern has been. The problem here is we've now got confidence way up, job openings down, so this just fits in with what we know about the election, that it's very tight. There's no way to predict.
Yeah. All right. We're going to talk more about that, Mike. Thanks for joining us. Mike McKee there, international economics and politics correspondent. I want to bring in Neil Grossman. You may have seen him sitting here on the desk. He is the co-founder and former CIO at TKNG Capital. He's spent decades working in the financial industry. He's been a proprietary trader, an asset manager, a market maker, used to advise the Norges Bank on, I guess, math is the best way to put it, right? You're a mathematician, really. What was your master's in fluid dynamics before you got your JD at Columbia?
Large scale dynamics.
Tell me what you think in that case about this labor market. Perfect for that. We've seen the JOLTS number come in a little bit weaker, and we have obviously the non-farm payrolls coming out on Friday. October historically a very strong month. So what do you expect?
Historically, unadjusted, the economy adds someplace around 1 million jobs in October. Again, the hurricanes are going to make this somewhat difficult, as well as the implications of the Boeing strike. So you may see it lower. I think going forward, these hurricanes, particularly the extent of them, was really significant. So across the Southeast, there's going to be an enormous demand for rebuilding. So I think if you want to look forward, the impact of this as we look out is probably going to be positive for the economy at this point. I'd also guess that, look, I mean, this has been a wildly strange political season, and maybe on the confidence, I think people may be just so happy this is almost over that, you know, we'll get back to somewhat of a normal. In terms of the number this weekend and week, I would have just generically expected a number probably between 175 and 200,000. That's what we've been averaging for the last 12 months. We've now really reverted to what is a traditional labor market. In any event, we've sort of unwound the entire long-term impact of COVID. I mean, the numbers were staggering, both in the early stages where there was a significant drop, and then, of course, the recovery.
Right.
So, you know, I think we've really just normalized the economy from that perspective. On the other side, Matt, you and I were talking about this, which is the impact of how the deficits have been working. And, you know, I think this is one of the problems that's very, very difficult to fully evaluate, but we're running deficits on the order of 8 to 9% of GDP, when a traditional economy, which is basically most of my life, has been on the order of, let's say, 3.
Right. And it seems like, you know, that's the one certain thing about this election, is that the deficits are going to go higher no matter who wins. But I want to focus in first on what you were saying about the economy, this normalization that we're seeing. How should the Fed read, of course, the numbers that we're getting? You bring up all the noise that we have, the hurricanes, the strikes, et cetera. The Fed has already unleashed that 50 basis point cut. What does the path forward look like?
Well, let's start with it. As Matt and I were talking about, I totally disagreed with a 50 basis point cut. And there are a litany of long-term reasons for that. But even in the general scheme of what happened, this was an institution that in June and July was saying, we're still not really sure of everything. And, you know, and then one meeting later and 2 functional reports of employment weakness later, there was what I would call full-scale panic. If you look at the historical nature of Fed cuts, those type of 50 basis point cuts are either coming from very high rates or in the face of very, very weak markets. And, you know, Chairman Powell said, we want to recalibrate. In my mind, recalibration is a slow process that allows you to see the impact of what you're doing and understand it. You know, I call the recalibration the new transitory right now.
Well, you know, I want to kind of point out to what's happening in the market here, because I feel like this consumer confidence data speaks to this idea that conditions are still easy. And if you think that stimulus is still propping up the American economy, propping up the American consumer, do you fade this trade?
Well, I mean, it depends how you want to fade the trade. Look, I think equities are very pricey. And as a general matter, that means the risk reward is significant. On the other side, the bottom line is I think you're seeing what I would have, in fact, Matt and I think, talked about the last time I was on, the most logical outcome of what's been going on, which is high liquidity, a Federal Reserve that tends to favor much more accommodation and dovishness, is a steepening yield curve. And I think the thing to really watch, in my perspective, is just how high interest rates can go, even as the Fed cuts. You've seen that 50 basis point cut has actually raised long-term rates rather significantly.
More than 50 basis points,
much
actually,
more than
if you
50.
Take a look at the long end.
If you go back,
430 on the 10-year right now.
Yeah, it's wild.
If you go back to the 1992 election, interestingly enough, as George Bush was segueing to Clinton, we were just coming out of a recession, but at that point in time, the yield curve was about 400 basis points steep. I think the 3-year, if I remember, the 2-year note was sitting around 3 to 3.5, and the long rates were in the 7.5. to me, there's no reason why this type of yield curve is not something we may be looking at, which is a very scary outcome.
With a 7% 10-year.
Why not? I mean, it depends what the inflation numbers are, but you've got to understand we're also looking at this staggering increase in the supply of debt.
I want to ask you about inflation and your perspective on that, because we did see gold rise to an all-time high again today. Bitcoin, I mean, I don't know how seriously you take it, but it's still at $71,000, and it's a pretty liquid market, right? What does that mean to you in terms of the potential for inflation to rise again?
The potential for inflation has not gone away. This is the other side of the coin of what the Fed's been focusing on. First of all, if you go again looking backwards, they've spent the last 15 years up until the last the year talking about inflation averaging, right? They were so worried when inflation was 1 3/4% that they had to promise people liquidity to push it up to 2. We still haven't gotten to 2% inflation. We're on a core basis over 3. Headline has come down. But the real question is we've spent now, 4 years averaging about 4.5% to 5%. So anything above that 2% trajectory is well into the distant past. And until we get there, number one, we're going to continue to really deviate. But more importantly, the central bank has not said what, in my view, it should say was 2% is not just a target, it is an outcome. And the bottom line is, if all you do is get near or to 2%, and then all of a sudden this thing starts to move away, then you're going to be, it's going to be problematic.
No, we've got to hold there for a long time in order to work out the 4s, the 6s, the 9s that we were looking at before.
Look, you can go 20 years at 2% and you're still going to be at 2.5% average or whatever it is. Working out the 2 means going below 2, but they're not going to do that. There is an embedded fear for some reason of inflation falling anywhere below, 1.5. 0, they're 1.5 to 1. They seem to think that deflation is this nightmarish outcome, which might well be if you're going to go to a negative inflation rate. But what's wrong with 1%? I mean, if you go, we've had 1% inflation with 3.5% unemployment, and the Fed panicked with that. I don't understand that.
Then how do you inflate your way out of this debt crisis?
Well, you shouldn't be inflating your way out of it. That's the problem. I mean, I know that's an economic concept, right? It's really a mathematical concept of discounting the liability side of your equation versus the asset side of your equation. But the problem is, if you're going to inflate your way out, and the yield structure is going to reflect that, and the currency is going to reflect that, and your cost of goods, all you're going to end up, you want to find a very stable, long-term environment where you have good growth, maybe a small amount of inflation to help you do that. But at the end of the day, one of the physics concepts is that if you add energy to an unstable system, you're going to destabilize it even further.
We got to cut it off there, Neil. We're running up against the break.
I'm sorry. We've got producers in our ear. Of course, that is Neil Grossman of TKNG Capital. Coming up, we'll speak to Kara Murphy. She is Chief Investment Officer at Kestra Investment Management. This is Bloomberg. All right, let's get a check on these markets. Of course, at the top of the hour, you had jolts coming in lower than expected. You had consumer confidence much higher than expected. You take a look at what that's doing to the S&P 500, bringing it back to unchanged. We were lower, but now back to that neutral level. We'll see, of course, how that trade develops. If you take a look at big tech, though, we are firmly in the green now, not by too much, but to the tune of about 0.2%. The bond market, it's interesting. Originally, you had yields fall back to unchanged territory, now a little bit higher on that 10-year Treasury yield, higher by about 3 basis points, Sonali.
And we're going to talk about those markets more now with Kara Murphy, Chief Investment Officer at Kestra Investment Management. And, let's start with today's trade, because you're seeing the S&P 500 shaking off a lot of its woes after that consumer confidence data. You still see most major sectors in the red, but where you see some excitement is when you look at the NASDAQ 100. And what a time before you have big tech earnings really hit the tape. How much is riding on these earnings to keep this market lifting higher?
It's hard to overstate how important this week is and how much we have going on, because not only do we have 5 of the 7 Mag 7 reporting, but you're in the last couple of days of an election where razor thin margins up and down the ballot. And then you have really important economic data coming out. We saw consumer confidence and, of course, jobs data on Friday. So when we look specifically at earnings, it's incredibly important for the Mag 7 to show up, have really good earnings for this quarter, and be optimistic going forward. Collectively, those names are expected to increase earnings about 18–19% this quarter. I mean, that is remarkably strong given how good earnings have been the last year and a half. But everybody else in the market, the other 490-ish in the S&P 500, earnings there are expected to be about flat. So those folks simply have to show up and not blow it. And so far, so good.
So far, so good. In terms of this quarter, it doesn't look nearly as strong as last quarter or next quarter. Obviously, we've lowered the bar coming into less than 4% expectations, and we're not seeing as many beats as we typically would. So isn't this earnings season overall a little bit disappointing?
I'd say it's okay. Again, when we look at beats relative to historical in terms of revenues, earnings, we're not that far off historical averages. What I find even more interesting is how the market's reacting to these earnings. So when we look at large cap names, the market isn't sort of buying those stocks as much as they have in the past. We're seeing the market showing a preference for small cap names. And when names are missing, we're seeing the market punishing small cap names less than their large cap brethren. So, and that's the second quarter in a row that we've seen that kind of dispersion. So I think what we're starting to see is a changing preference and where the market's willing to give some of these smaller names that have been out of the spotlight a little bit more of a pass.
How much do you think that comes down to valuations, though? Because you think about some of these small caps, I mean, they're pretty inexpensive when you compare that to some of their mega cap peers, especially the tech names, Kara.
I think that's very important. I mean, again, the Mag 7 in aggregate are trading at about 33 times. That's a pretty rich number, even compared to their own histories. Then everybody else is trading about 15 times, which is a pretty reasonable number and pretty attractive. As you go further down the cap spectrum, mid cap, small caps are trading at similar type discounts. So sure, I mean, expectations have not been nearly as high. So it's a little bit easier to look through ho-hum earnings in the near term on the idea that they'll start to rejuvenate next year.
So how much hope do you have in that rejuvenation here, especially because we're kind of hanging on the edge when it comes to the election? And if you have one direction here, you might enter a sphere where corporate taxes are higher, for example. Something I don't understand, Kara, is you have investor enthusiasm really just a sky high right now about certain Trump trades, but you've also seen the last 2 years the S&P 500 this year and last year rise about 20% or more in a row under the Biden administration. So ultimately, what do you think the election means for the direction of travel for investors?
So I think ultimately, we have to have a very heavy discount between what folks are saying on the campaign trail and what actually gets put through. And I think anybody who comes into the White House is going to have to contend with this enormous deficit and this preference for lower taxes. None of us want to pay taxes, but you still have to be able to pay for all of that. So I think we need to significantly water down those economic policies. And this concern about working down the deficit over time, I describe as a very American problem. It's not a party problem, and will take a really long time to be able to work through. So I think those are things that are going to be important, but ultimately it's going to be about corporate earnings. And so far, those trends are looking fairly strong, particularly from some of these smaller names.
What do you think about gold at an all-time high? Bitcoin also right now, Kara, at 71,000 and change. Is that telling us something about inflation expectations that the University of Michigan doesn't?
It's a really good question, and one that I get a lot from our end clients. So gold in particular, we spent a lot of time looking at to try and determine, is this an inflation trade? And what we found is that gold isn't consistently a good inflation hedge. What it seems to respond more to is simply central bank buying. And what we're finding is that there's a really wide swath of central banks around the world who are looking to diversify into gold, both for economic and for political reasons. So I think given that, it's not necessarily an indicator of what's happening with inflation, but sometimes a political decision that's happening behind the scenes. And so a little bit divorced from the economic cycle.
Kara, but 10 seconds on Bitcoin. I mean, how do you read that? That was a beautiful description of what's going on with gold, but what do you make of digital gold?
So crypto, in my mind, is a good sign of excessive risk taking. It feels to me like some investors have some excess change, jingling around in their pocket, and they're looking for something further out the risk curve to be able to invest in. And often crypto is where it ends up.
All right, funny money, going into funny money. Kara Murphy, really appreciate your time. That is Kara Murphy of Kestra Investment Management. Now, still ahead, what the largest U.S. home builder says about the housing affordability crisis. Details in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. First up, Waste Management raising its revenue forecast following upbeat third quarter results driven by higher market prices for its recyclable commodities and increased landfill volumes. The company also said that it benefited from the use of automation, which has cut labor costs and boosted efficiency. Next up, McDonald's sales falling short of expectations thanks to weakness in overseas markets like France, China, and the Middle East. Now, the fast food giant said that it plans on introducing a new value meal early next year. And of course, these results don't include the impact of that recent E. coli outbreak. And finally, we have D.R. Horton reporting weaker than expected home orders in the fourth quarter. The biggest U.S. home builder says that high interest rates are keeping buyers on the sidelines. D.R. Horton focuses heavily on first-time buyers who face affordability challenges. In fact, mortgage rates in the U.S. increased for the fourth week in a row to 6.54% on a 30-year fixed loan. Let's take a look at these markets right now. Of course, about an hour into the U.S. day, you can see currently higher. Of course, we got some pretty good consumer confidence figures at the top of the hour. The S&P 500 up about 0.2%, a little bit more. If you take a look at big tech, the NASDAQ 100 higher to the tune of about 0.5%. We have Alphabet, we have AMD after the close, so we'll keep an eye on that one. And pretty quiet in the bond market. Coming up, we'll speak to Bruce Van Saun. He, of course, is the CEO of Citizens Financial. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. Taking a look at these markets, pretty much unchanged on the S&P 500, erasing those earlier losses. Of course, green on the screen when it comes to big tech, even though all the fireworks are after the close. Bond market pretty quiet. And of course, even though we're mono-focused on tech earnings, there's been a lot of companies that have already reported. So let's walk through them now with Jess Menton. She's sitting to my left. Jess, what do you got for us?
So I talked to y'all earlier about what was happening with VF Corp, and especially when you're talking about what's happening in the retail and the shoe space. But I wanted to bring up Crocs because there's a huge move today.
A different type of shoe.
A very different type of shoe. The ticker symbol on this CROX. If you look at this, that stock's down about 19%, on pace for its worst day since actually March of 2020. So we all remember what that time was like when the onset of the pandemic was happening. It was bad.
Why is it bad March of 20? I feel like when you're told you have to stay in the house for months at a time, then you buy Crocs. Like that's
know. You also
a house
they
shoe.
have a cowboy boot one too.
Really?
They made. Yeah, Carol Massar showed it on one of the simulcasts.
Is that the Hey Dude, or is that something?
What would you
I think
buy?
this is different. Yeah,
Ugg slippers.
Ugg
You see it in
slippers?
Becker shares. Anyways, you know, we're also taking a look at Xerox here, which is actually at a record low right now.
But wait, we didn't get why is Crocs off so much?
Well, actually,
did someone tell us?
Well, its growth forecast was around 3% for its annual revenue, so that was at the low end of what shareholders and what sell-side analysts were expecting.
Ah, there you go.
I've heard that they're not popular anymore among teens, Sonali.
You know, things come, they go. We'll see where it goes from here. But anyways, for Xerox, it is the lowest ever. And so it's actually moving even more than Crocs is, if you could believe it, more than 20% right now.
Yeah, its stocks was already down more than 50% year to date. You look at this, like to your point, Sonali, XRX is the ticker symbol for this, down 20%, worst day since October of 2000. So its revenue outlook also was cut on weaker sales outlook. So you're seeing that actually it also tempered its revenue guidance for the full year, and it did cite lower than expected equipment sales. So that's what's pressuring that stock.
Who ordered these stocks? Who put these? You can't go Crocs and then Xerox and then Boot Barn, right? It should follow Crocs.
Well, that's only if you're trying to tell a story.
Right. Also, Sonali, you should be doing Boot Barn.
I mean, the amount
You're
of
the
things.
big boot buyer on this desk.
Yeah, I've been there way too much.
I
but
love that.
clearly, it's not helping them. What's going on there?
So, you know, that stock's actually close to 70% higher this year, but right now it's down 20%, worst day also since March of 2020, unfortunately. So actually, you're seeing a shakeup here in the C-suite executives. So actually, CEO Jim Conroy He actually said he would depart from the company on November 22nd, and he's actually going to be set to become the CEO of Ross Stores. So that's where you see a big move there and a big pullback in the stock.
I wonder what brands. Does Boot Barn, are we talking about the high end? Are we looking at like Lucchese?
Like middle of the range
middle range.
here.
Yeah?
Right.
Yeah, I mean,
Okay.
there are a pair of like rose-colored boots that are on my checkout right now, so add that to fourth quarter sales.
Yeah, I don't know if you can buy
Watch
dressage
out.
boots there. I've never actually been to a boot barn. You've brought us all bad news so far. We should keep it going. Let's talk about PayPal.
Well, PayPal is another one to keep an eye on, too. So if you look at this, it's actually, I mean, unfortunately, it's actually down 6% right now. So worst day since February 8th. But also its revenue growth, that actually viewed disappointed. But its third quarter profit did beat expectations. So there were some good outlooks, but that was backward looking. So when you're looking at the final 3 months of the year, that's where it missed those expectations. But there were some bright spots.
All right, all right. You have to squint, but there were bright spots. All right, Jess Menton, always great to see you. Of course, that is Jess Menton. She covers equities and everything else for us. And let's switch gears here because we've been talking a lot about the election. But before we get there, runners will be off to the races this Sunday at the New York City Marathon. And for the second consecutive year, Citizens will be the official bank of the race. The bank has also announced a $100,000 grant to help improve green spaces in the city. For more on the race and the future of Citizens, I'm pleased to say we're joined now by Bruce Van Saun. He is Citizens Financial CEO. Bruce, it's great to speak with you again. Interested to see, of course, that you're sponsoring the marathon for the second year in a row. And it really lines up with this push that Citizens has made into New York City in particular. Where are you on that? Tell us about the progress that you've made in New York City.
Yeah, so we have been at it now for 2 or 3 years in New York, and it's been really going well. So I would say when we look at our regions, it's the fastest growing region that we have in the system. We're growing households at kind of mid-single digits, and we're growing deposits at mid to high single digits. But it certainly is an expensive market, and there's a lot of competition there. So we've looked for opportunities to elevate our brand, and partnering with New York Roadrunners and the New York Marathon, such a distinctively New York experience, really has been beneficial to us.
Well, I want to get to the rate environment here, Bruce, because the Fed is starting to cut. Obviously, it looks like they're going to continue. Is that bad for you? Net interest margins is something we instantly think about with banks, because obviously, especially a local bank will make all of its money, or the majority of it, from getting more on loans than it pays on deposits.
Yeah, so it's a little complicated, actually. The banks typically are benefited from higher rates, but we have different strategies to cope with lower rates, including hedges. So I'd say we're pretty neutrally positioned at this point. I think that there's other benefits from falling rates that you'd have to take into account. So first is it'll stimulate more loan demand. So you'll get the volume effect that will be beneficial. You also stimulate deal activity. So capital markets fees should kick in more. And it's beneficial to borrowers, particularly the more levered borrowers like commercial real estate owners will have a chance to, refinance at more attractive rates. So that'll be good for bank credit costs. So you kind of have to look across to all of the different ways that banks perform, and lower rates, I think, are going to be beneficial. And that's one of the reasons bank stocks have been performing reasonably well last 30 days or so.
You know, Bruce, we have right now a price of your stock over the last 1 year surging about 82%. Clearly, investors look to Citizens as a place of stability here in a regional banking market where there are a lot of other concerns. We have an amazing story on Bloomberg right now about how, for the first time since the great financial crisis, buyers of top-rated commercial mortgage-backed securities are suffering losses, with AAA bonds going bust. How much more pain is there in parts of this real estate market, especially in some of these big cities that you're keeping an eye on, and what might it mean for the industry?
Yeah, I would say, all real estate is local, so it certainly depends kind of where the properties are located and what the tenant structure is, if it's an office location. Office is really the area that has to readjust. So there has to be some losses recognized You have to take some stock out of circulation and basically get supply back to equal demand as companies need less office space, given the slow return to office trends and the kind of permanence of hybrid work arrangements. So that's going to play out gradually. I think most banks are well reserved for their exposure there. We feel we are. So I think it's not big on the worry list these days from investors in bank stocks that they've seen banks get their arms around. No surprises currently. It is tough on the office segment, but banks are working toward it.
Yeah, it seems definitely like investors have found other things to worry about, to your point. I want to talk a little bit about private credit here, private capital. It's an area that you've highlighted as a potential opportunity for Citizens, especially when it comes to leveraged lending there. Where are you on that journey? How do you differentiate from some of your peers, particularly in the regional space?
Yeah, so we've been focused on private capital for a long time. So starting with private equity sponsors who increasingly own more and more of middle market companies in America. So you want to be able to service them. You want to be able to show them deal flow. You want to be able to finance their transactions. So I think we're very well positioned for that. The more recent emphasis has been on private credit. So as the private equity folks look to expand their overall complexes, they're getting into private credit, and there's direct players in private credit. And they're looking to finance more leveraged transactions. In some cases, they're disintermediating banks, but in many cases, banks don't play at that end of the leverage spectrum. So banks are looking to see how can we serve those players. They need credit themselves, so can we lend to their fund complexes in a safe and secure way. And I also think that we've developed good relationships there, and we're also having opportunities to lend to those complexes. So net, I think we're positive as opposed to it being a worry bead in terms of kind of opportunities leaving the banking system.
Right. Well, that's exactly where I wanted to go, because it seems like private credit, that industry, and the banking industry are kind of frenemies at this point. And my question to you was going to be, have you seen private credit encroach on your territory? But just to crystallize your point, it sounds like you're saying no.
Yeah, I mean, there will be some deals that we lose, but at the margin. But for the most part, we're playing in our sandbox. They're playing in a slightly different sandbox, and then they need banks to make their strategies go. So you have to turn that kind of risk into an opportunity.
I'm curious, as we get into this part of the cycle, when we get into regular way bank lending to consumers as well, Bruce, I'd love for you to comment. We saw consumer sentiment really start to tick up once again. Do you think that this could be a bullish signal for NII and lending moving forward? Do you think people are ready to take on debt to start spending?
Well, I'd say there's a couple of considerations there. One is the higher rates have been an impediment from people wanting to borrow. So as rates come down, that'll stimulate, I think, more borrowing and lending. The other aspect has been uncertainty. And so I think more broadly in the economy, the election coming up, and the prognosis for are we going into a soft landing? Are we going into a recession? I think the more we see clarity on that, we get through the election, we have a better sense as to is the economy holding up? It seems like it is. That gives people more confidence. So I would say the two things: less uncertainty, more conviction on the path of the economy, and then lower rates. The combination of all of that should mean that there's going to be more loan demand as we head into 2025.
All right, Bruce, great to get your take on these issues. Great to have you on the program. Thanks so much for joining us. Bruce Fanson there of Citizens Financial Group. And are you going to run the marathon?
No.
Does either one of you run?
I do halves. I can't do more than that.
I know you run marathons, right?
Well, I was a middle distance runner in college, so I like to keep the races shorter.
All right.
Yeah, we're the same.
Yeah, I like to keep my races very short. Coming up, a story about the Pentagon's ability to adapt. Hoover Institution senior fellow and former National Security Council staffer Amy Ziegart joins us to talk about the changing landscape of modern warfare. This is Bloomberg.
All right, it's time for our daily Wall Street Beat conversation, and warfare has changed over the past few decades. Can the Pentagon keep up? David Weston spoke with former National Security Council staffer Amy Ziegard about the rising threats from adversaries as the battlefield evolves.
Warfare has changed dramatically, even in the past 5 years, let alone 50. So we look today at Ukraine fighting Russia. Russia, by all objective measures, was a much better military, spent more on its military, had a larger military. And yet Ukraine has been grinding that war to a halt. And Ukraine has been defeating, in large part, the Russian Navy without a navy of its own, using drones and low-cost capabilities that they are just putting together. So we're in a different era of warfare where it's low-cost quantities of capabilities and pretty high tech that can diffuse relatively easily. That's very different than what we faced.
The Pentagon is a pretty big organization, and I suspect with a lot of momentum behind it. How does an organization like our Department of Defense, with all the contractors affiliated with it, how do they adjust to really dramatic changes in warfare?
Well, the Pentagon's a giant organization, and it's hard to adapt for any organization, much less one as large as. If I could let me take a step back, David, if I could.
Yeah, please do.
So I think we were talking about the changing character of war. I think many Americans are familiar with the Indiana Jones movie, Raiders of the Lost Ark, that famous scene where there's a machete-wielding guy in the market, and Indiana Jones takes out the gun, the superior technology, and shoots him. That's been the strategy of the U.S. military for the past 30, 40 years. We're going to out-engineer the adversary. Doesn't matter if we're outnumbered by them, but our capabilities are going to be exquisite, and that's how we're going to win. That's not the battlefield anymore. Now, if we're Indiana Jones in that marketplace, it's 10,000 machete-wielding guys, and some of them have guns too. And so Indiana Jones is going to run out of bullets before he runs out of bad guys to shoot. That is essentially the United States and what we face with the rising threat of China in Taiwan, the South China Sea. And war games show, CSIS war games show, we run out of ammunition within a week or two in a fight with China.
Going all the way back to the Cold War, which I remember, a lot of U.S. defense was based on the theory of deterrence, because there was one major adversary in the USSR. We had to deter them. What do you do with those 10,000 guys with machetes? Because it is China, to be sure, and Russia, but there are a lot of non-state actors and smaller states that are in the game now.
This is the most dangerous and the most complicated threat landscape the United States has faced since 1945. This was the conclusion of a recent bipartisan commission on national defense strategy. And so we have great power competition with China and Russia.
Absolutely fascinating stuff there. Amy Ziegard speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. And we'd love to hear from you and what you think about our shows on Bloomberg Television. We appreciate your feedback. If you just scan the QR code on your screens to participate in our survey, I think you'll get a coffee, a cup of coffee, like a gift card. I don't know, but also you have the ability to sound off, right?
You sure do, and we'll be here on the other line to listen, I suppose.
Maybe we'll scan the QR code as well. This is Bloomberg.
The expectation today is that Donald Trump will win the White House in just a few days. We'll know shortly. And big picture, the reduction in uncertainty is almost always positive for asset prices. And we're at that moment of peak uncertainty. It is a race that Trump is favored to win, but it's almost a coin toss.
That was Citadel's Ken Griffin speaking at the Future Investment Initiative in Saudi Arabia earlier this morning. And this comes just 7 days ahead of Election Day here in the United States. Here with more is Bloomberg's Mike Shepard in Washington. And it's interesting to hear Ken Griffin say this. Of course, we know that while Griffin has given $100 million to a pro-Republican PAC in this presidential cycle, he actually has not given to Trump. But somebody else in this community as well spoke more directly to Trump here and said that Trump is in a much better base of knowledge of how the job works and how to be efficient and effective in doing it as opposed to where he was in 2016. So does this signal a greater interest from the investment community when it comes to Donald Trump, you think?
Well, look, Wall Street has so much at stake in this election, and it's really key for us at Bloomberg to understand what the biggest names out there are saying about what's going to happen next week. Ken Griffin is one. Steve Schwartzman, whom you alluded to just now, is another. And at stake for them is what happens on the regulatory side. Will their companies and their investments have an easier or harder time doing deals? Will they face greater scrutiny from the SEC and other regulatory agencies? And likewise, they want to know about the impact of the economy. But what's interesting, the common thread in their comments today is how close they see this election playing out. And that reflects what we're seeing not only in the polls, but also in some of the early voting tabulations that we're getting in. It is very hard to discern a direction favorable for one or other candidate in this race, not only at the top of the ticket, but also going down ballot.
Well, Shep, on the other hand, when you watch these Trump rallies, especially at Madison Square Garden over the weekend, the president and the people around him, the former president, are trying to create this aura of inevitability. And I wonder if that doesn't come back and bite them in the end, because don't you want, in some ways, to feel like the underdog so that your voters get out there and show up?
Well, it's a great question because, you know, the Madison Square Garden event on Sunday was cast by Trump beforehand as a place where he could really make it a triumph and declare victory ahead of the election in a way and look to seal a result ahead of time by getting this vindication from what he sees as a movement that is able to go to New York, a very blue city in a blue state, and somehow claim the mantle of all this support there. Now, it could haunt him, but not only for the reason that you outlined, that it risks leaving voters overconfident and thinking they don't have to go to the polls. There was a lot of racist and misogynistic language that was uttered by other speakers at the event, and that has been picked up on by the Harris campaign, and they're using it against Trump to say that, hey, look, he is the former president is bringing his grievances. He is bringing a divisive approach to the country, and that is exactly what we don't want. And we see Donald Trump today and last night, too, during his remarks, having to backpedal and defend against that.
Mike, we only have about a minute left with you, and I want to get your perspective on what's happening down ballot as well. We talk to investors all the time, and at the top of their wish list is a divided government. What's the state of play there?
Well, the congressional races are just as key as the presidency this time around. And what we're expecting is that Democrats have the edge in terms of retaking the House just based on the way we look at the electoral map. And likewise in the Senate, we see Republicans just because they have fewer seats that they have to defend than Democrats do. And it looks like Republicans may have the edge in taking the Senate. But again, a lot of those races are going to be very close to call come election night.
All right, 7 days to go. Really appreciate your reporting. Of course, our thanks to Bloomberg's Mike Shepard joining us from Washington. Meanwhile, let's get a quick check on these markets. A little bit of a lift now. You have the S&P 500 up about 1/10%. Big tech making a run for it. The NASDAQ 100 up about 0.5% or so. And of course, we have some big earnings after the bell, as we've been drum beating to. Alphabet, AMD, and then a whole host of other names over the next several days or so.
Yeah, I'm really looking forward to seeing how this earnings season plays out. But then I'm going to be psyched to see how the election plays out. And after that, I'm going to be interested in what the Fed does.
A lot to...
I guess you got to squeeze non-farm payrolls in there as well.
Right, and before that, I'm very excited to see what Jobs does on Friday, as noisy as it might be.
Well, I'm excited for tomorrow on Open Interest. Of course, a great lineup of guests joining us, including the CEO of Lumen Technologies, Kate Johnson. This is Bloomberg.